Okay, good morning and welcome everyone to a very special session that we're hosting today with the Small Exchange, where we're doing something a little different than we normally do. We're going to be actually trading live today, something we don't do very often. And I'm very excited to have with me today Pete Mulmat from the Small Exchange to introduce some of the Small Exchange Futures products and to talk a little bit about the broader markets here today. So first of all, before we get started, Pete, I just want to say a big thank you for being here today. Pete, I think you are on mute. Let's see.
That would be me, my friend. So we're all
There you
set.
go.
Thank you so much, Tony, and thank you for having me. I'm very excited about bringing in, talking a little bit about smalls, talking a little bit about the story of the exchange, and most importantly, the products and the opportunity.
Yeah, I'm very excited to talk a little bit about, the benefit of futures and what you guys have been doing with futures products. When you guys, when we spoke about a year ago, about starting talking about the small exchange products, I thought you guys were a little crazy trying to start a new futures exchange. But I will say the products that you guys have built have really changed the way that I look at trading futures. I've started my career as a futures trader, but
Right.
I'm back to trading futures. So before we get started, just a quick disclaimer: what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, we did do a session here a couple of weeks ago talking about small futures. Today, we're going to do a quick introduction to futures contracts, just for those of you that are new to futures, so that you have a better understanding. But this is not a class on futures contracts, but we'll give you a brief introduction, what the benefit of futures are, what type of exposure that you get, and then giving you a sense for ETFs versus futures, because a lot of you that are currently trading some of the products that normally you would trade futures with, you're doing it through ETFs. And there are some benefits there, but there are also many limitations, if you will. And that's really where I think the small futures products step in. And during that process, I'll give Pete a little bit of time to explain to you the thought process behind what they were trying to do when they created this exchange and these products. And I really want to showcase this by doing some real, looking at the markets together and doing some trades together and seeing how that works. And then we'll open this up for Q&A here at the very end. So that's what we're going to go over here today. But like I said, Pete, I do want to give you a minute to talk a little bit about your background here. But just before we get to that, I actually started my career, in the FX world. I was a Forex trader starting about 15 years ago. And the first derivatives contract that I traded was a futures contract, was the E-mini contracts. I actually have an old Twitter handle called E-mini TOS because I was trading E-minis on the Thinkorswim platform, listening to Tom giving his daily webinars, teaching how to trade futures and options. And that's how I got my start into the derivatives world before getting into options. So, I was a day trader in E-mini futures. I traded that for many years, but, trading E-minis was something that you had to stay glued to your screen, if you will, from about 8:30 in the morning to about 11 a.m. because the contract sizes were fairly sizable. You couldn't just put on a trade and come back to it a few hours later. There was some challenges there, especially for when I was starting out the relatively small account trading that. So I want to give you a moment to just introduce a little about yourself. And I will say, I found out something about you this morning that I did not know. You come from a very long line of futures traders in your family. So please, could you just tell a little bit about your background and kind of how you end up where you are now?
I'd be happy to. And Tony, you and I started in exactly the same spot in the world of FX. And I started trading. I was very fortunate. And you're right. My father was a cattle broker, and my grandfather was actually a pork belly trader and was one of the founding members of CME. And my grandfather died at 92 with pork belly still on in his trading account. So he was trading right up to the very end. So I started when I was 19 and started trading FX. And at that time, the FX pits had 7, 8, 9 people in each of them. And there were Swiss, Canada, Aussie, yen, and at that time, D-Mark. So I'm really dating myself, starting in 1981. So this is before the euro was even in existence. So I started that standing in the pit with everyone else and learning the the core concepts around trading product and getting engaged with it. And for me, I was incredibly fortunate that I learned as the markets grew. And what I meant by that is a busy day for the 8 of us was trading 1,200 contracts. And everybody walked out of the pit feeling like, oh my God, we just went through, the car wash of trading. We're soaking wet. By the time I left the pit and migrated off the floor, we were doing 250,000 contracts a day, and there were 250 of us knuckleheads standing in an octagon, not much bigger than your average living room. So it was a wonderful way to learn, and you know what? Learn by watching others too, Tony. So that was very, very interesting. You were where the market was being made and the trades were being consummated. So that was a very important edge. And you also, though, had the inefficiency of you were trading one thing. It was very difficult to move from product to product. And you mentioned how you started in the world of FX and moved to the world of e-minis and the flexibility we have now with the leveling of the playing field. And that's really what the electronification of trading did, was level the playing field in terms of access for everyone. I remember I used to trade a lot of crude oil, which was at an exchange in New York, and having to fight my way out of the pit, pick up a phone, call the guys in New York, and then wait 3 hours for a fill to come back to find out where I had bought or sold them. And it was never a price that you were happy with. So, that challenge in being able to expand your base and be able to diversify your choice of products and move where it's interesting, it's so important that we have now. So I started my career trading in the pit. After about 20 years, we saw the migration start to take place. The open outcry markets, which were less efficient for the couple of the reasons I just stipulated, moved to the world of electronic trading. And 2 of my close friends from the pit formed a company, and we moved off the floor together and started doing arbitrage, basically trading futures against the spot markets. So spot FX against the currency pairs and treasuries against cash treasuries. We did that for about 12 years, and it very quickly became a speed race. And we would reinvent our software to stay competitive. And every 2 or 3 years, we'd have to do that. It was a great run. And it got down to a point where competitively, it was challenging to stay as fast as you needed to. And we looked at it, was it worth the investment, the 4th iteration, or should we kind of take a step back? And that's what we did. We managed some money for a period of time. We were a CTA and also a CPO. And then I actually was asked by the CME to come and actually build an active trader program for them. Did that for 3 years. And it was fascinating because while being a member of the CME for 30 years, you think you really understand the organization and the overall business. What you really know is a very narrow slice of that pie of truly how an exchange operates. And it was fascinating to work for the CME and see how that large organization worked. And very fortunately, I met Tom Sazon, and we would do presentations together for Thinkorswim. And we were able to strike up a friendship. And I was very fortunate that on a car ride back from one of our presentations, we had a very brief discussion, and we talked about the opportunity for me to come and join the Tasty Trade team. And honestly, it went from discussion to the ability to come. I think I started 3 days later. So a very exciting. It's the way Tom, you've worked with Tom for many years. He tends to have an idea and execute on that very quickly. And about 3 years ago, one of Tom's visions was that he saw the challenges of traditional futures, the difficulty in the lift. And I think we all look at adopting new product. What's the opportunity? We know we get diversification, different exposure. What's the lift? What do I have to learn? Where am I going to get tripped up? And in the world of institutional futures, and what I mean by that, the existing world, as you mentioned, very high notional products, very different tick sizes, very different expirations. I think if you look at CME's calendar, and granted, from 3 years of working there and 30 years of a member, I love CME, and I am in no way casting shade on them. But the confusion of taking product and living in the world of fractionalized, decimalized, different tick sizes, different expirations, and different products was a challenge to adopt, learn. And I felt that at CME, that growing the retail pie was always a challenge because of complexity. So Tom sat back and he's always advocated this. How can we make these products more accessible to a larger audience? Well, first we need to make them more simple. And then we need to standardize things like tick size that I mentioned, like expiration. I don't know if I mentioned this, but I believe CME has something that expires every single day of the month. So what expires when and how is a challenge. And then making the products of an appropriate size. I think we're going to talk a little bit about the comparison between ETFs and futures. And when you look at that comparison, and I'm not going to go too deep here, is trading futures in terms of the capital efficiency is great. We'll talk about margin and how that works, but the disproportionate amount of notional exposure when you trade that leverage product relative to what you're trading in other worlds can sometimes create a very difficult and challenging learning experience. And you tend to run out of time learning, or you tend to run out of money learning how to trade the product because it's so big. So that's kind of been my journey and my walkthrough coming to building this exchange and launching it over the last 3 years. We've been so excited because we have come through with small, standard, and simple products that we'll talk, and I'm so happy we're going to talk about, that are of a size that they fit and that you can learn. So everybody's got strategy, everyone has an opinion, which is great. So how do I put that into play? How do I learn how a product works, trade it effectively, build out strategies without the burn, without the disproportionate size? So those were our goals. And I think, as a team, we've done a great job, and we continue to innovate with product.
So thank you so much for that background as far as how you ended up here. And that's exactly what we want to talk about, because like I said, when you guys came to me a year ago saying that you were guys going to start a competing futures exchange, I genuinely thought you guys were a little bit crazy, but I see the vision now and I actually believe in it. And I've actually started trading futures again. I never thought I'd get back into the world of futures, especially as an options educator, if you will. So I'm really happy that we're going to be able to sit here and talk a little bit about, like you said, small, standard, and simple, which is really what the futures market has been missing, especially for retail traders. So just a quick introduction of futures contracts. A futures contract is similar to an options contract that allows two parties to assume or offset the risk of a price of an asset over time. It's simple as that. And we'll go through some examples to make this a little more concrete as to what that means. And when it comes to futures contracts, I think that the most important part is that they're standardized and they're exchange traded, which means that you can trade them very actively in and out in an exchange. And that there's plenty of liquidity that you can trade. And some examples of that are ones that you're probably familiar with, like corn and British pounds and oil and treasury bonds. These are some of the more actively traded, including the S&P 500 E-mini, which is probably between treasury bonds and E-minis are probably the two most widely traded futures that are out there.
Spot on.
But when we talk about futures products, there are many benefits. One, it gives you direct exposure to a fairly large group of assets. And these are the group of assets that we all talk about as equity traders, because as equities traders, we don't just look at stocks. We look at interest rates, we look at oil prices, we look at gold prices, we look at interest rates, all of these different asset classes that we look at. And then at the end of the day, we end up just trading stocks off the back of that. So we have all these views, we have all these research on these different asset classes, but largely we may not be trading them. So futures, first of all, gives you direct access or direct exposure to these other asset classes. And they are what we call capital efficient, right? And this is something we're going to talk about a little bit as far as what that means, being able to control a fairly sizable notional contract or notional position with a relatively small percentage of the margin requirement to do so. There are also tax benefits because unlike a stock trade, a 1256 contract, which index options and futures fall under the same class, are taxed at a 60-40 rule, where 60% of your capital gains are taxed at long-term capital gains, 40% at short-term. So if you're trading in a taxable account, there is a tax advantage of trading futures versus trading. So for example, if you're trading GLD versus gold futures, you have a tax advantage there trading gold futures versus GLD. And I think the more interesting one, especially for smaller trading accounts, if you have under $25,000 worth of assets, is that there's no pattern day trading rules. So for those of you that like to trade actively, like I did when I was trading E-minis, I could trade in and out 20 times a day, and I didn't have to worry about the pattern pattern day trading rules, even if you had under $25,000. So there are a lot of, I would say, interesting benefits to trading futures if you want direct exposure to an underlying asset class like you would normally currently get from an ETF. But as Pete said, in his 30 years of dealing with futures, I think it's an interesting that you call it institutional futures, right? Institutional futures, meaning they're really contracts built for hedgers, built for institutions to trade them, because as you said, there's a lot of challenges, or there's steep learning curve in learning how to trade futures. One, the contract sizes are of very different shapes, very different shapes and sizes, and they're generally speaking fairly large, not necessarily suitable for retail. Many of them run in the hundreds of thousands of dollars per contract. And from my perspective, the most confusing part is not actually the contract size, it's the different tick sizes across all the different products, right? E-minis trade at a quarter of a tick, one tick, which is a quarter of a point. Treasury bonds trade in fractions. There's all different types of tick sizes for different products. And that is a learning curve in itself. So as you trade different products, you have to learn different tick sizes. Unlike when you trade ETFs, things are standardized. Everything's a penny, right? And then most confusing of all is that depending on which futures contract you trade, you have different expiration dates. And the last one, risk of physical delivery, this no longer exists. But back in the day when you were trading futures contracts, if you forgot to close out your futures contract by the end of the month or by expiration, you did have risk of physical delivery. So these are some of the challenges, if you will, with trading futures contracts that exist with the existing futures contracts with CME, right? These are the contracts that I traded on. These are the contracts that Pete, you traded on for many, many years. So, the interesting thing is that now for equity, as you say, the electronification of trading, Pete, this has allowed ETFs to kind of step in and take some of the learning curve, if you will, of futures products and provide equity investors, stock investors, some way of getting direct exposure to some of these assets without having to set up a futures account and without having to learn all of these, the learning curve, if you will, because it's set up in the same structure as a single share of a stock. So ETFs have allowed investors, equity investors, to gain exposure to this very large selection of assets, arguably larger than what you have with futures contracts, right? Because you can have ETFs on, there's 2,000 ETFs listed these days on just about everything under the sun you could possibly think of, every type of region, every type of slice of the market you can find. So you have a very, very wide selection of assets, and they're fairly easy to understand. And you can trade them on any time horizon. You can hold them and for as long as you want, right? If you want to buy SPY or QQQ, you can hold on to it for years and just hold on to it. But there are some concerns about efficiency when you're trading ETFs, right? The main thing is that it requires at least 50 to 100% margin to hold on to that trade. So they're not particularly capital efficient. They don't provide any exposure, any leverage if you were looking for that type of exposure. And they are subject to pattern day trading rules, which I think is the biggest concern for a lot of retail traders or smaller traders who want to trade more actively, but they can't do it using an ETF. And we do see that depending on which type of ETF you're looking at, they do tend to have some pretty large tracking errors over time. Holding on to GLD, you might have a pretty good exposure to gold, but trading something like USO has very poor exposure to accrued, for example. So you can't hold them for very long in terms of trading. So as you can see here, you have the futures market that provides you with this direct exposure that you might be looking for, but they're sized, it's difficult for retail traders to learn and start trading, and they're not sized properly. ETFs solve a lot of those problems. They make it easier, they make it smaller, they make it more efficient, but they lose efficiency. You need a significant amount of capital to trade them, and you're subject to the pattern day trading rule. And that's where the small exchange comes into play. A bit of a merging of both worlds, and some innovation added on top of that to which is something we're going to talk about here. But the small exchange really gives gives you the efficiency of futures with the ease of stocks. So here, Pete, what I'll do is I'll give you a few minutes just to talk a little bit about the ethos that you guys have here with small, standard, and futures. When small, standard, and simple, when you guys think about creating brand new futures contracts that are suitable for retail, addressing some of the things that we just talked about here.
Tony, that was a great synopsis of basically, in a wonderful way, the construction of futures and the benefits of a neutral security, which means one that I think you and I take for granted from the futures world, but that's as easy to sell as it is to buy. There is no short selling restriction. There is no pattern day trading rules, and the margin is exactly the same on both sides. So we've got this wonderful thing called a futures contract. How do we make it? The first point, and I think you hit on this, is how do we take it from the world of institutional complexity and size down to a manageable level? So we built all of our small exchange futures that sit with a notional between $1,300 and around $6,000. So a much smaller notional size. Standardization takes a number of different forms. I think, you talked about cash or physically settled futures. We went through that process several times, and we called it the idiot tax because we would forget to manage something. We would have to go to the exchange and do something called certificate redelivery, and they charge you $1,400 a contract to basically, hey, you were stupid, you didn't manage your position. So what we did is we standardized in a number of ways. Standard ticks. So whether you're looking at a 10-year yield future, precious metals futures, or an equity index futures, each tick is the same. It's $1. Our products are quoted like an ETF. So there are 2 decimal points to the right, and each of that 1/100th of a move or 0.01 move is $1, whatever you're trading. Standardized in terms of expiration. They are all cash settled. And I think you and I both, trading the physical world and the cash settled world, would always pick, geez, I wish they were cash settled. Because all that means is if you don't manage, if you do nothing, what happens if futures expiration is you just get a realized debit or credit in your account. There's no management that you need to do. Obviously, most of us like to roll our product forward, either maintain our exposure or cover that position. But if you don't, there is nothing that you need to be mindful of. So standardization in terms of expiration, I need to know one date out of the month, and all those contracts cash settled. So I've got no hook or problem with them. And no matter what I trade, same tick size. And the simple runs through that. We've got a brilliant team of guys building product at the small exchange, and they probably have 100 years of trading experience between them. And we sit down in a room, and there's a proclivity to run down the rabbit hole. And what I mean by that is to create the next shiny new toy that we want, that is a great slice of the market, but has so much complexity to it. It's a cool trade, but it would be impossible to really create for practical explanation. And we have this sign in the room that says, if you can't explain the product in 3 sentences, you've built too complex a product. And that's what we wanted to do. So whether it's yield-based treasury futures. So I think rates are going higher. I think rates are going lower. I can have a simple product that gives me that expression of opinion. All of the products resonate with that simple, clear, and easy expression of product that we live with every day. And what I mean by that, Tone, is, you know what? We don't live with bond prices. We look at a 20-year treasury and it's trading at 156 and 11/30 seconds. Now, I've traded these for 20 years and I've got an idea what the yield is, but I couldn't tell you what the yield is from that price. Why do they do that? That works for the institutions. That's the way they trade, not the way you and I trade. We have a mortgage, a car loan, a student loan. We all know the yield of those. And that's what we want to trade. Every product resonates in that fashion.
Yeah, and I think that's really what resonated with me. As far as standardization, I think for me the big thing was the tick size. So you guys standardize every single futures contract as $1 per tick. That's easy to understand. It's the same as buying 100 shares of a stock. If you buy 100 shares of the stock goes up by 1 cent, which is 1 tick. You make $1. If it goes down by 1 tick, you lose $1. Right? That's simple. It's symmetrical. It's easy to understand. It all expires on the same day as your monthly options expiration. Most most viewers here today are options traders. You know that the third Friday is when your options expire. So all of the small futures contracts expire on that same day. So it's an easy way to remember that. And just the simplicity of the products that you guys have created, for me was a game changer, because for the longest time, we talk about the 10-year yield, but you couldn't trade the 10-year yield. You can trade TLT, you can trade DXY, you can trade other products that are somewhat linked to the 10-year yield, but you couldn't trade it directly. And the fact that you guys created a product that allows you to trade the 10-year directly, I think has been a game changer. And, from my perspective, the simple and also is what you were saying before, direct exposure. And what does direct exposure mean to me and to the viewers here? For me, direct exposure means if I'm bullish on Apple, I know all I have to do is go and buy Apple, right? And that's as simple as what the futures contracts provide you with. If I'm bullish on the markets, I can buy an index future. If I'm bullish on the 10-year yield, I can buy a 10-year future. If I'm bearish on gold or precious metals, I can short a precious metals futures. It's simple as that. And I think the best way to learn, Pete, is always to go through some examples. So today we have a few different trade setups I want to walk people through. And these are trade setups that we have been talking about here earlier this week. On our Tuesday morning market outlook session, we talked about the markets. We talked about the fact that we felt that the volatility and the chop was starting to ease a little, especially as economic indicators are starting to improve. And these were potential buying opportunities. And that's exactly what we're starting to see play out here with the technology index. So this is the small technology index. And Pete, I think the closest thing that we can kind of relate to, if you will, in the broader markets that most investors are familiar with is probably an index similar to the NASDAQ 100 or the QQQ that some investors are familiar with. And this index currently is trading at 6408. Now, I think the best way to think about this for investors who are new to futures trading is to think of this as like a $64 stock. And each futures contract is for 100 shares of the stock. So you can trade one contract at a time. That's the minimum you can trade, which is the equivalent of trading 100 shares of this particular futures contract. Now, let's just talk a little bit about the price action here, what we've seen here. And this is something we've talked about here over the past month or so. We've had this chop, or what we call a consolidation range, after the market peaked here in mid-February. And we've put in this pretty significant support level here around 61. This has been a major support or resistance level that has held pretty much since this chop has started. And we finally have started to find a little bit of stabilization and momentum. Is just recently broke above the 20-day moving average today. So that is the start of what looks like an improving conditions here for the technology indices, and the momentum is starting to improve. So when I look at this, I'm certainly have a more bullish bias here on an index like this, and I look for potential upsides here. I think the first ones you would look at are the last swing highs, which are 66 and 68. Those would be my first primary targets here to the upside. And then if we break above those levels, I would target roughly that 70 level here to the upside. So, trading this is similar to, I would say, trading the Qs, but, like I said, at a fraction of the cost of the Qs, at $64, and you're trading 100 shares, the equivalent of trading 100 shares. But the major difference, Pete, here is that the margin requirement on these contracts are significantly smaller than one contract than if you were trading 100 shares of the Qs. So let's just take a look at where the Qs are right now. We are at 323 right now. So to buy 100 shares of the Qs, that would cost you $32,000 roughly. So even if you were trading on a margin account and you needed 50% margin, you're talking about $16,000 roughly to trade 100 shares of the Qs. So let's take a look at this particular example and set this up here in the small exchange. And I'm sorry, on Tastyworks, and take a look at what trading this would look like, just to give you a sense for comparison, right? So we said one contract of the Qs, roughly $16,000 in margin. To trade one contract of the sticks, like I said, think of this as a $64 stock. Buying 100 shares of that stock normally would cost you $6,400 or so in cash, $3,200 in margin. But as we see here in the small exchange, to trade one futures contract, your buying power is roughly $550. So so Pete, the margin requirement on this is what, 8% right now?
You're absolutely right, Tony. Now and we'll talk a little bit about margin that expands and contracts. depending on two factors, movement and volatility. But you're right. So the equivalent amount of notional there, about 6 contracts here, which would be about $36,000. You're controlling that for about a little over $3,000 versus the 16,000 you highlighted with the ETF. And that is, we can talk about margin and everything, but there is your clearest form of capital efficiency. So I love the analogy of a $64, you're looking at a $64 stock, because that the way they're constructed, the way we quote these, is analogous to that. We want you guys to feel comfortable that when you come in, the movement in terms of that representation of pricing looks very, very similar. And our sticks, one of the things we did with Unique Product was to build things. This is the technology index. Is it a copy of NASDAQ? No. We found through history, anyone who's tried to copy somebody else's product has failed. We wanted to innovate. So our sticks index, while having a very strong 0.97 correlation to the Qs, has its own set of components. And there's 4 sectors of technology that we believe are actually updated and refreshed. So does it give you that technology exposure? Are the names we're used to trading Apple and Amazon in there? Absolutely. But it is a little bit updated take on that. And you can actually, if you're ever curious, Tone, if you want to see the actual constituents, you can go through that watch list and it will break down for you under the presets by those components. So you can actually look at, it's called the Stick 60, those 60 components and their weighting and performance within the index.
Yeah. So on the, and just to explain on the Tasty Works, so you have preset watch lists for the small exchange futures. You have a preset watch list for the small 75, which is the broad base index. And then you have this stick STIX, which is the technology index. So you can actually look at the components of the technology index and you see big names like Apple, Accenture, Amazon, Activision, BIIB, all of these names that we are commonly associate with the big mega cap technology names you'll see in this particular index. So you guys have created your own technology index, and that's what we're trading here. And that's exactly, this is the chart of the underlying index itself. Right. And then the futures product is right here that you can trade. And you can just click on the bid ask price to buy and sell, just like you would on a traditional equities platform. Now, the one thing I will say here, Pete, you guys, this is a relatively new exchange. So when we look at number of contracts, certainly we're not seeing the tens of thousands, hundreds of thousands, or millions of contracts that are traded a day on this type of product. And I think it's important to address this because some investors have asked about liquidity, and I was concerned about it myself when I started taking a look at this, seeing a bid-ask spreads of, let's say, 8 cents on a $64 stock. Normally, if you're trading stocks, we're usually seeing spreads of under a penny, sometimes around a penny, especially for something actively traded. So when you see something like 8 cents, it is concerning because that's paying $8 on the round turn for transaction costs. But I will say, when I was placing orders on this, what I have been doing is I've been placing my limit orders at the midpoint to effectively minimize my transaction costs. The same way I would place an order like I would on an options trade. If I had an options trade that had an 8-cent spread, I would place my limit orders at the midpoint or maybe 1 cent off of the midpoint to try to get myself the best possible execution, or an execution very close to what I felt was a fair value. And the one thing I will say is that I have seen my executions get filled pretty much instantly when I was able to place my trades at the midpoint. So one thing to be aware of, even though you do see wider spreads, even though you do see that the volume is in the few hundred contracts per day, I have been able to see executions at the midpoint, and at worst, no more than 1 cent off of that midpoint, as at least what I have seen. So Pete, I'd love to hear kind of your comments a little bit as far as liquidity and trading these products to lower the impact of transaction costs.
Right. And Tony, you're so spot on. One of the greatest costs of us doing business is slippage, and we want to minimize that slippage, and that's the cost of getting in and out. So we have, if you go across, March was actually a record month for the small exchange, which is great. So we have been growing volume, onboarding market makers as we go through products, and we're going to look and see the 2 years and the 10 years, 2 ticks wide, the metals 3 ticks wide. So that centering up of the market makers lets us do exactly what you're talking about, which is work orders in the middle of the market. I think rarely did you and I, whether it was from my time trading in the pit, where your market making was to be a bid and offer, or even now, rarely do I lift an offer or hit a bid. I'm usually working something in the middle of a market, whether it be an options trade or a futures trade. And you know what? The same thing is holding true here. And what we're seeing now is enough participation. So those middling of the markets, as you said, are getting filled. And in things like the 10-year in precious metals, you're seeing the market 2 ticks wide, 3 ticks wide. So it's very simple, very easy to get filled at that midpoint. And that's what you want. For pairs trading these products or just trading them outright, the liquidity continues to improve. Before our time here, I just got off a call with another market maker that is onboarding. And as they see it's such an interesting paradox with a new exchange. It's chicken and egg. And what I mean by that is the faster your volume grows, the more your participatory base grows, both from the retail end user and the market maker. So with the growth we've seen in February and March, the market makers that were on the sidelines are now taking a more active role, and we'll continue to see those markets tighten up within every product and all the new products we're launching as we move through the balance of the year.
Right. And I think that's very important, because that is something that I have, myself have been concerned about, and I've heard, questions from investors. So it's very important to address that when you do see these wider spreads, just like an option. Think of these bid-ask spreads as the sticker price that you see when you walk onto a car dealership, right? You don't pay the sticker price, you negotiate around it. And the great thing about a two-way market is that it gives you a midpoint. A midpoint can be utilized as fair value. And you saw, I just placed a trade live on this, placed it at the midpoint. I was able to get filled within about 20 seconds of placing that trade. So, you might see it move out to as wide as 8 cents that I've seen here on the technology index. I've seen the 10 years be much tighter, about 4 cents. But remember, you can negotiate around that. But just to walk you through this, right? So let's say I bought this around $64 and the stock went, the future or this index went up from 64 to 66. So let's just do some round numbers, right? Let's say I bought it at 64. It's the equivalent of buying 100 shares at 64. If it rallies up to the $66 target, my first initial target, that's effectively $2 times the 100, let's just call it the 100 multiplier that we have on each futures contract. That translates to a $200 profit if it does rally from 64 to 66. That is I would say simplicity, or the standardization that you guys have applied to these futures contracts, no matter which small futures contracts you trade. If the index moves up by $2, you're looking at a $200 profit. If it goes down by $2, you lose $200. Okay. So it's really easy to understand, in my opinion. So let's just go through another example here.
Right.
The next one I wanted to take a look at was precious metals. Now, we've been talking about gold and silver being a little bit under pressure here. Both gold and silver, and just to be, and Pete, just to clarify, this precious metal index is not gold or silver. It's a combination of gold, silver, and platinum with a different mixture, correct?
That's correct, Tony. And what we wanted to do is, again, so often with products, with indexes, there are, or within an asset class, there's selection dilemma. Do I pick gold? Do I pick silver? Do I pick platinum? We wanted to give a holistic precious metals exposure. So we created this combination of gold, silver, and platinum. So if I want to be long precious metals and one day I buy gold and it's silver that's up 4%, there's that disconnect between I had the right strategy, poor product selection, or just unfortunate product selection. So with this, the majority of it is gold, then silver, and there's a sprinkle of platinum. And you think, why did you add the platinum? Well, platinum's a very high volatility metal. And when options on futures come, that will create a very premium rich environment for us. So this is that holistic exposure, as you mentioned. And we have been with each of the precious metals, we've been on quite a tear to the upside here over the last 12 months.
Yeah. So, I think it's really interesting because when I first looked at this index, I thought to myself, this is going to be difficult to explain, right? Like you're not trading gold, you're not trading silver, you're kind of trading a combination of each one. So how do you analyze a blend of three precious metals? But then I started thinking about, all the times that I, went long gold, expecting precious metals to go higher,
Right.
but on that day, silver was the one that moved 5%
Right.
and gold only moved 2%. And I missed out on that move, or vice versa, right? So, and this is really where I thought the precious metal index was interesting, because it gives you a blended exposure across the boards, because gold and silver, in itself, the spot gold and silver is quite volatile. We traded spot gold and silver, and it was notorious in getting stopped out because of
Yes.
short-term volatility, and then the precious metal went back in your favor that you expected to.
Right.
So by actually blending the precious metals, you actually lose out on some of that short-term volatility that sometimes you get in the spot markets, and I actually quite like it. So I've really come around to this precious metal index. So just to take a look at the chart itself, you've had a pretty big range that this index, just like gold and silver, has been trading in for quite some time here. And we're near the bottom end of the range. We haven't quite broken the bottom of the range, but we certainly are testing that level. And we have a major support level around 70. And I would say over the past few weeks, or past few, I would say months, we continue to have higher highs and higher lows, which isn't particularly strong for a bullish view. My views is that this is likely going to continue moving lower here, especially as I expect dollar to potentially still continue to strengthen here. So the bearish momentum has certainly started to turn a bit bearish here. So when I'm looking at this, my first target is really the $70 support level. A revisit of that $70 support level. As you can see, the 21-day moving average acting as resistance. It's now below the 200-day moving average. So you really have quite a bit of a shift in momentum here over the past few weeks, 3-4 weeks or so. So my first initial target is down to about the $70 level. And then if we break that $70 level, that's really where things could get a little ugly here for this index. Gets all the way down to potentially 64. You have this kind of a bit of a vacuum here between 70 and 64. So I think that this could get down to the 64 if we do break that $70 support level. So this is really an interesting one, because if you were trading GLD or SLV, most investors here, I think, that are watching today would not go out there and flat out short sell GLD. Right. Or SLV. The margin requirements on that is fairly sizable to do so. So what we want to do is let's compare this particular, trading a bearish view here on precious metals, small index, versus trading GLD or SLV, right? So GLD is at 161 right now, a big bounce here from today, and SLV is at 621.23. So let's take a look at this precious metal index. So as you can see, precious metals is a little tighter, 72.31 by 72.35. So a 4-cent spread here, a little tighter here. But like I said, it's like trading a $72 stock, right? Or $72 ETF, and you're trading 100 shares of it when you're shorting this contract. So, what I've been doing is I've been placing orders basically at I've been placing orders at pretty much the midpoint, so which is at 72.34 right now, and this is the equivalent of a $7,200 contract. So the margin requirement, as you can see here, is $517. So margin requirement here is what, 6% roughly?
Yep, and the volatility is in a little bit on, and that's one of the factors in margin here. So we're seeing that same capital efficient. Now it's interesting, Tony, you pointed this out. The Reg T margin in the equities world gives you 50% on a margin account. The amount of margin, or that leverage you get in futures, is dependent on volatility in the product. So some products will have that 10-to-1 leverage. Others may have 15-to-1 or 20-to-1 or 6-to-1. So it depends on the volatility of the underlying and the movement over the last year. But you will always see a more capital efficient product than that. And I think you're taking an interesting position in metals here. And You're right. We're seeing lower highs and lower lows. Without that 70 level, has been such an interesting level in SPRE that has held here. But what's changing? Well, rates are moving. And I think one of the things metals have traditionally traded on is, especially this rally with a zero interest rate environment, when you see yields start to expand a little bit, you start to see that non-interest bearing asset, precious metals, start to become slightly less attractive. And I think that and the dollar that you mentioned will be this drag. And you know what? It'll be nice for us to find and see if we can find that new tradable range, but possibly between 65 and 70. So I agree with you. I think we have the opportunity here to try to trade a little bit lower range here and find some opportunity in that.
So I think it's interesting that you bring up that leverage. I'm sorry, the margin requirement changes as volatility changes. Could you just talk a little bit about how often that can change?
Right.
Can this contract that currently requires $517 tomorrow demand $5,000 in margin? How frequently does margin change? Just so we can talk through that.
Right. And it's a great question because, first of all, the simple answer is margin does change, but not not that often and not by that much. Margin in the futures world is something called SPAN, Standard Portfolio Analysis of Risk. That's the acronym. All that means is it takes and looks at the last 252 trading days or 1 year of movement and volatility of the product and applies a value to it. So what has to change? The amount of movement or the amount of volatility dramatically. And you will see margins increase or decrease based on that, but very infrequently. The market itself, again, those two variables will dictate that, but you won't see it go from $500 one day to $1,000 the next to $2,000. I mean, that's always a concern because if you saw a margin like that, it would dramatically impact what with a finite amount of capital in your account, as we all live with, it would dramatically impact the amount of capital you are using per strategy. So you can expect that to move up and move down, but in incremental ways and not that frequently.
I think that's very important. So taking a look at this, right now I see spreads are actually 1 cent wide, 72.30 by 72.31. I've seen this 4 cent wide. I've seen this 1 cent wide,
Right.
depending on, as the size is relatively small here. I'm guessing someone else has a limit order and is basically is that asking price here at that moment. But placing orders near the mid, I have been able to see. I have too many positions on right now. Actually, I might have to close out a couple of positions to continue trading on these, but I've been able to see the ability to get these filled at the midpoint fairly
Right.
quickly on many of these trades. So we'll come back here to this after I close a couple of positions here. And the last one I want to talk about is the 10-year yield. The 10-year yield is something that we have talked about a lot here at OptionsPlay.
Right.
We continue to have a view that rates can continue to drift higher and will likely to continue to drift higher into the end of the year, especially as more stimulus spending and more infrastructure spending is likely coming down the pipeline. That's going to put the inflation expectation is what's been driving the move in yields. And just if you look at the technicals, strong uptrend. We've had a recent pause here over the past, let's just call it the last couple of weeks, that has allowed equities to stabilize a bit and actually start to see some moves here to the upside. But we have broken above that 382 fib level. This is something that we've talked about very heavily, which is around the 155 basis point level. It's come back to retest that level as support and looks like it does have the potential opportunity to continue moving higher to the 50% fib level, which would target about 185 basis points to the upside, which is still another 13 basis points here to the upside. And then if we do break out above 185, the 618 fib level is up at 220 basis points. So let's just walk through that again, because the way that the small 10-year yields are quoted is in effectively 1/10 of a basis point, right? So $16.77 on this futures contract equates to 167 basis points on the 10-year yield.
That's absolutely right. So 100 or 1.67% and 7/10. So that is the increment, again, the dollar increment. So just moving, we kept the convention so it's consistent, but to know what the yield is at any particular moment, that's telling you it's 1.67% or 167 basis points with a little 0.7 attached to it. And you're absolutely, so interesting, Tony, because we spent so much of last year between 80 and 90 basis points. And, here's a product that's almost doubled. And so we've gone from 80 basis points to 160. So a tremendous amount of movement as those expectations have started to play out in the marketplace. What's normal? You go back 5 years, the average, the mean reverting part around a 10-year is, I think, 3.25 or 330 basis points. So is there range for this to move? Absolutely. We're getting a very dynamic market. And I think that spending you mentioned about the amount of borrowing that's going on, at some point, the market is going to assign, there is a cost for the government to continue to borrow endlessly. And I think we're going to see, are we getting back to normal? We're moving away from that zero bound, which is great. We made I think in the height of the pandemic, we were down to 45 basis points. So certainly a lot of movement to the upside, but this is going to, I think the 10s, the 30s, and the 2s will all have tremendous tradable opportunity throughout this year as the market tries to determine what should real rates and nominal rates be for the next year, considering the amount of debt that's being pushed out the door.
Right. And that's exactly right. And that's our view here on the 10-year. And I think let's just quickly review, a potential trade here on the 10-year. So it's the equivalent of trading a stock that's at $16.84. Right. Buying 100 shares of that would cost you $1,600 here, but the margin requirement here per contract is only $220 on a $1,600 contract effectively. And what this allows us to do is, and just think of this as a $16.82 stock. If it went up to 185 basis points, which is roughly our first target, you're looking at about $130 in profits per contract, right? So it's a really clean way to trade the interest rate itself, because and any other, and many of you that have followed me on CNBC, we've been playing the short dollar play for quite some time up until the past few months, and we've been playing it through all types of crazy stuff. We've been short UUP, right? Which is the closest thing to the dollar index with respect to an ETF. We've gone long commodities through agriculture stocks like FCX. We've done we've been long EEM, emerging markets, which has a negative correlation to the dollar index. So there are all these crazy ways to get exposure to this idea of short dollar. Yet, this is just a clean way to trade the interest rate itself, right? Nothing like this existed before. When you guys showed me this product, that was actually what brought me on board, Pete. I'll tell you that. This was the shift in momentum for me to say, hey, I think these guys are onto something. The fact that I can now trade the interest rate directly itself has been a game changer for me and has gotten me interested back in trading futures contracts. So just to show investors here, currently trading at 1680 by 1684. I've been placing limit orders pretty much at the midpoint and seeing fills within fairly quickly here, and I've been able to place trades and get filled fairly quickly. As you can see, that was the fill right there, less than 2 seconds after placing an order at the midpoint. So a lot of, I know a lot of investors have said, hey, there's very little volume on these products, and I'm not, there's no going around that, right? The volume certainly doesn't compare to the CME, but the liquidity is there. Those are two very different things, right? It's one thing to say there's no volume and there's no liquidity, but there's plenty of products out there that don't necessarily trade very often that are plenty liquid, meaning you can get filled at the midpoint, or usually maybe 1 cent off that midpoint, even if there's not a lot of volume traded on it or there's not a lot of open interest. So keep that in mind, especially if something was just listed, right? If the next month futures contract we're just rolling over to the next month futures contracts, you're not going to see a lot of open interest because it just started trading. So keep that in mind, because open interest also reflects how long something has been listed for. So that's just a quick review here. And Pete, I will say there's one thing that we do want to talk a little bit about, which is flattening versus steepening. So You guys have heard me also talk a lot about the steepening of the rate curve, right? Meaning that the 10-year yield is rising faster than the 2-year yield. And we talk about this, yet we don't have a way to trade it, or rather the only ways that we've been talking about getting exposure to a steepening rate curve is through banking stocks, right? Banking stocks will benefit as this rate curve steepens, and will be a net loss if we get a flattening of the rate curve. So let me just pull up the rate curve here. And Pete, you can talk to this a little bit, but here is the 10-year versus the 2-year. As we can see here, the interest rate differential between the 10-year and the 2-year was somewhere in the 60 basis point level here right before the election. It was around 62 basis points on November 2nd, right before the election. And since the election, we've seen this huge expansion where the 10-year yield is now 150 basis points higher than the 2-year yield. And the steepening of the rate curve is beneficial for banks, and it's a very indirect way, in my opinion, of getting exposure to the steepening of the rate curve, because you're taking on all this risk for the banks as well, right? The banks have a lot of other different exposures to just the rate curve. So the futures products, the 2-year and the 10-year futures products, provides a unique way to get exposure to this. So Pete, could you talk a little bit about how you would think about getting exposure to either a steepening or the flattening of the rate curve through these futures products?
Absolutely, Tony. And you're spot on. A dramatic move of steepening and deferred yields with greater duration rising quicker than that shorter dated yield that is a little bit more tied to what the Fed's doing. And we know the Fed's stuck at the moment at 0 to 25 basis points. So what we're looking to do is, and previous construction was, and I loved what I call tangential exposure. So the banks traditionally, the story is they borrow short, they lend long. A steepening yield curve would be profitable for them. But you pointed out wonderfully is there are so many other things that go into the value of a bank short of the yield curve. So there is a, and we see this trading ExxonMobil for oil exposure. Well, we know they extract oil. They also do 100 other things. So keeping it simple and keeping the exposure, my idea, my exposure line up, that's where these 2s, 10s, and 30s work. So to construct a yield curve trade, since trading in the world of institutional futures, we have to take products quoted in price, the bond price, which means we have to weight them. The weighting is dynamic. It's very challenging. To trade yield, all we're doing is trading the difference in two products that are consistently sized. So all I need to do is all these spreads and yield curves are 1-to-1. If I think the 2-year note and the 10-year note are going to diverge, which means the yield curve is going to continue to steepen. So there's two kinds of yield curve trade. A steepener, that means the yield difference between the two durations is going to expand, or a flattener, which means they're going to come in or revert. So if we're looking at that steepener, it just means I'm buying the longer duration. I'm buying the 10s and I'm selling the 2s. And with the Tastyworks Paris Trader, you're spot on. You can put that together as a single trade. But any of these steepeners or flatteners in the world of smalls are done 1-to-1. They're very simple. And what I love about this, Tony, is even of 30 years of trading institutional bonds, when I look at a knob spread, notes over bonds, which would be our 10 years versus our 30s, there's a weighting to it. That weighting is dynamic. And I couldn't tell you within a reasonable amount what the yield was from that price difference. Here, you can just look at the subtract one price from the other, as you mentioned. What has it moved in the last 3 months? 150 basis points. How do I know that? Because I just subtracted one price from the other. And the trade setup is as simple as this: buying one and selling the other on a 1-to-1 basis.
So how would you size this? I think this is very interesting, right? Because one future is trading at $16.82. The other one's trading at $1.62. How do you think about sizing when you're trading this as a pair?
Well, and you know what? Usually we like to get notionals on pairs close together. In this particular case, I trade them 1-to-1, because what do we want to trade? We want to trade the difference in the two yields. That's our impression. You and I both believe that there's a lot of normalization that needs to come within the yield curve in terms of steepening. So how do I trade that steepener? It means I am buying that longer duration or 10-year note, and I'm selling the 2-year note. I'm looking for those yields to move further apart. So I always do these steepeners and flatteners as 1-to-1 trades. this is the one instance, because we're trading a reflection of yield and price, where we don't notionally weight the two products.
Well, that is fantastic because, and that's exactly why. That's what the beauty of this standardization, right? Is that fact that you can trade one-to-one. You don't have to figure out the notional value of each contract as you would if you were trading the bond futures, where you would have to do the notional amount equivalents in order to trade the steepenings and the flatteners. Here, because you're trading the yield directly itself, the contracts are tied to the yield. So one basis point move in the 10-year is the same basis point move in the 2-year. So you can trade one-to-one. That is beautiful. I will say that I've learned something new here today. And that's certainly something that I will take away from this session. So with that, that we did cover a lot here.
We sure did.
I do want to spend just a couple of minutes answering a couple of questions before we wrap up for today. We talked about margin requirements for each contract. We talked a little bit about cash settlement. We talked a little bit about transaction costs, but let's talk a little bit about the transaction costs. What are the fees to trade these products?
So when you trade a future, there's always two fees: the exchange fee, and then the fee your particular brokerage firm charges. Now, from the exchange side, we have two sets of fees. One for a subscriber, and what that is for a one-time $100 fee, you can purchase a subscription in the exchange. What does that get you? 50% off of fees. So fees are traditionally 15 cents a contract. That makes them 7 cents. Now, there's a lot of other great things that comes with it in terms of research and content with that subscription. But so the fee for a non-subscriber, 15 cents. For a subscriber, 7 cents. So these fees are kept, we talk about friction, Tone, and that's the cost of doing business short of my idea. So what is that? It's slippage, as you mentioned and highlighted so well, that difference in between the bid and offer. Then transactional costs. That's the next piece of friction, or what fights against my P&L. And by keeping them at that incredibly low rate, these are the lowest fees to trade futures across any product you can trade.
So that's fantastic to hear. And that's exactly what I have experienced. And just to be clear, that subscription that you're referring to that lowers your fees from 15 cents to 7 contracts, that is a one-time fee of $100, correct?
That's absolutely right. A one-time fee for $100, and that lasts for the life of the trader, no matter where you're trading. So that is portable, and it is there is no renewal fee. There's no nothing. So it really is that one-time bite of getting your fees at the lowest possible level.
Okay, perfect. So I'll just give you just a couple of minutes, just talk a little bit about, how investors can find out a little bit more about the small exchange and the subscription that you're referring to. And then what I'll do in the meantime is I'm going to take a look at some of the questions, and I'll pull together a couple of questions for us to look at together.
Great. So as Tony mentioned, all these great benefits of futures, from the tax treatment, which, it's wonderful. We know the difference in the world of equities and ETFs of, if I don't hold something for a year, it's short-term capital gains versus long-term. Futures, whether you hold them for a minute or a year, are all taxed with a blended long and short-term rate. So it's a tax efficient product as well as a capitally efficient product with the span margining and the neutral security aspect, the ability to buy and sell. And one opinion doesn't cost me more in terms of capital and slippage than the other. So we stuck with this, again, this smaller size, this equivalent size to this larger trading universe. One of the challenges has been growing the retail base of futures trading. And Tony, you pointed out so well, that challenge is the size of the products now. Even things like mini S&Ps have doubled in their notional size, and that margin has doubled with them. So I believe it's around $17,000 right now for a mini NASDAQ contract to trade that contract. We wanted to keep that movement, that size of the product, and the efficiency all the same. Now, are our products more efficient in terms of leverage than bigger products? No, whatever world of futures you're trading, they all work off of the same span model. It's just, you saw that a 10-year treasury was $200, or a 10-year treasury note in the traditional futures world is somewhere above between $2,000 and $3,000. So capital efficiency, absolutely. Smaller size, which is so important, there it is. And as you mentioned, the standard piece, I can't overemphasize this enough. If you look at pairs between our two equity indexes, there is no looking at, is it a quarter of a tick that's $12.50 or 20 basis points that's $5? Everything's $1. I could track that spread and know what I'm up and down just by doing the math. And simple. We wanted to make them simple products that live in your world and you can understand every day. So how do you learn more about the small exchange? Well, go to smallexchange.com. We have tons of information there about the products, about the exchange, and about the subscription offer. So you can go there. Our YouTube channel, our Facebook, Twitter, we have been growing our presence throughout all those channels. And you can learn more about the products. There's a whole suite of educational content out there that will get you vested in our world and start to empower you with learning our products. So lots of great ways to start to, and Tony, we always say this, it's not smalls or, it's smalls and. We want to add product to your toolbox. So if you're trading futures that work, that's great. We feel that the smalls and their unique exposure and the simplicity they give you is a perfect complement to that. Or if you haven't traded futures, it's that great stepping stone into the futures world.
Well, thank you so much, Pete, for that. And for those of you that are interested in setting up a Tastyworks account to trade these small futures, you can do so using this link here on your screen, trade.optionsplay.com/tastysmall. And at this point, what we'll do is we'll open this up for Q&A. I'll try to answer a couple of questions here before we run out here for today. There were a couple of questions here. The first question is the small futures exchange regulated by the SEC? I know the answer to this question, but Pete, I want to give you an opportunity to answer this.
So futures exchanges are regulated by a different government entity, and it's called the CFTC, or the Commodity Futures Trading Commission. So a different regulator than the traditional equities world of the SEC.
It's the world of Forex that we come from, and CFTC and NFA. Right. Another question here, if I'm trading the smalls through an IB account, am I paying the IB fees plus the small fees?
Yes, you are. Now, some firms blend that all together. Other firms break it out. So it's really, you have to check with your firm as far as what the commissions are on top of our exchange fees. But again, it's a firm specific thing. So explore that with your broker and you'll find what those fees are. But I could speak to, from the exchange side, whatever product you're trading, it's 15 cents or 7 cents for the subscriber.
Right. And there's a lot of questions, I'll just answer this, questions about whether this session is recorded. All of our sessions are recorded and you can find them on our YouTube channel at youtube.com/optionsplay. That would be the best way to find this recording, as well as the recording that I did a couple of weeks ago with Tom, where we did another introduction here of the futures, of the small futures products. Is there a way to trade these in a practice account first? That's a great question, actually. I'm not sure of that.
And yes, depending on the firm you're trading through and the platform you're using, there are sim and demo environments. Tastyworks is working on that environment. It's not there yet, but some of the other firms that support the small exchange do have sim environments where you can trade the product.
That's great to know. Tom is asking a great question, actually. And I think we did address this briefly on the one that we did with Tom. And he's asking a question about, are there any rules that you can recommend when hedging a long portfolio of stocks using index futures? And I think this is an interesting question because, as an options educator, as much as we want to talk about buying puts to hedge your stock portfolio against a downturn in the markets, I don't think that's the most efficient way of actually hedging a portfolio. Meaning the most efficient way to hedging your portfolio is moving those assets into cash when you feel that a market's about to correct, and then reinvesting it when you feel the market is over. But we all know that moving into cash is not feasible for everyone, and not everyone wants to move into cash. And that's really where futures contracts become a very capital efficient way to actually hedge your portfolio. And I actually think that's the best opportunity for investors who want to remain invested. And only for whatever reason that you don't want to trade or can't trade futures, do you want to look at put options as a kind of a last resort, if you will, to that. So could you talk a little bit about, sizing when you're thinking about hedging a portfolio, or how do you think about hedging a portfolio using index options?
So, and it's a great point, because taking apart that portfolio, comes with costs and tax implications. So how do I manage my exposure? And you know what? Not in a binary fashion. Either I'm long equities or I'm not. And then it becomes a challenge of, well, which ones do I take off and which ones do I leave on? And I think you and I, from our years of experience, could say oftentimes we never pick quite the right ones. So going out and looking at the construction of your portfolio, you will find that usually it has a certain weighting to it. So you want to find an equity index that replicates some of those names, so you have some correlation to it. Then it becomes a function of what tool can I use to peel back a little bit of those deltas, a little bit of that long in a proportional way. Now, if I think there's going to be a mild correction and I want to peel off part of my position, I look at an equivalent notional value. So if I have a portfolio that, say, has $25,000 in stocks, and I'm primarily focused in technology, well, I go over and I take a look at sticks. I know it has a high correlation, a lot of those underlyings I'm trading, and has about a $6,000 notional. So how do I hedge? Well, I go in and I look at what do I want to, and I think you make a great point. Puts, you're paying not only a transaction cost, but you're paying a privilege for the hedge. In the world of futures, we want to be able to peel back some of those long deltas in a capitally efficient way. And we want to not make it a binary event. Either they all come off or they don't. And with large traditional futures, it's very difficult. A lot of us don't have a $150,000 portfolio, which is roughly what an ES future is right now. So with a $6,000 future, we can look to hedge 25, 50, 75, or roughly 100% of that future of that portfolio with these futures contracts. So I always tend to like to look, and if I want to hedge something and I feel the market's reached an extreme and I don't want to manage my physical portfolio, I like to start with managing a third. So some people will look at 20%, some people look to cut half. I will take a third off usually. So I'll use between one and two contracts here. So between 25 and 50% of that $25,000 portfolio with a short sticks position. And I will look to work around that hedge. If I feel there's more of a correction coming, obviously you can size that hedge up and size it down, but it becomes a very efficient way to manage those deltas, cut them back when you want, and then take those futures off and let them run.
I think that's a fantastic way to think about hedging your portfolio as not a binary event. And I think that's exactly right, because it's hard to have that binary. I think either markets are going to correct or they're not, right? There's always a spectrum of, things are getting worse or things are going, getting a bit more stable. So I think that's fantastic that the small futures allow you to scale in and out of a hedge. So I have time for one last question. I think this is a really good question because a lot of investors trade right now, if I'm not mistaken, you can trade the small futures at Tastyworks and you can trade them at Interactive Brokers. But a lot of our investors trade at other firms like Merrill and TD Ameritrade and other firms. So the question is, can you trade futures at the other firms? And maybe could you share some insights as to maybe when those firms might offer these futures products?
Sure. And we're working with both those firms, along with several others, very actively to engage them and get them on board offering our products. As the volume, the open interest, and the consistency of quoting, as you mentioned, Tony, that consistency of that quote becomes more and more robust, we will see that broader adoption. So you will look to see new firms coming on all throughout the year. And guys, you know what? One of the things I'm going to ask from you and all of your viewers and followers is we can go out and talk with them. One of the greatest things to push is customers reaching out to their broker. So if you want to trade these products, you reaching out and asking for them is a powerful part of the process of onboarding them. So please do that, or reach out to us and let us know who you're looking to trade, because that's a powerful message for brokers who are in process to prioritize that adoption or who are still in the consideration phase.
There you have it. So thank you so much, Pete, for taking your time out here today. I think this was extremely insightful. Even for me, I learned quite a bit here today as far as trading these products. So, I hope that this was helpful for everyone here that attended today to learn a little bit more about just futures products if you're new to futures products. And if you're not new to futures products, hopefully this gives you some insights into how you can utilize these more innovative futures products that allow allow you to get exposure to different asset classes in a easier and simpler way through the examples that we showed you here today. And Pete, I believe there are more futures products coming down the line. So I'm really excited to see some of those, because I'm excited to trade some of those myself, including some of the things that we learned here today about the steepenings and the flattening of the rate curves that you can trade using a pairs trade using Tastyworks. So Pete, I just want to thank you so much for taking your time out here today, and providing the insights that you have regarding these products and the market as well.
Well, Tony, I want to thank you and all your traders for taking time out to learn a little bit about the small exchange and get some great guidance from you in terms of adopting the product. Thank you again.
Thank you so much. And just a bit of housekeeping. We will send out the recording to everyone as soon as we finish processing that here today. In about 30 minutes or so, you'll be able to see the recording along with the slides. We'll send you some important links to subscribe to the Small Exchange subscription. So thank you so much. Have a great trading day.